Part 2. The efficient market hypothesis takes three forms. Point 3. The weak form maintains that past stock prices provide no useful information on the future direction of stock prices. In other words, technical analysis of past price fluctuations, cannot help investors. The semi-strong form says that no published information will help investors to select undervalued securities, since the market has already discounted all publicly available information into securities prices. The strong form maintains that there is no information, public or private, that would benefit investors. The implication of both the semi-strong and strong forms is that fundamental analysis is useless. Of the three forms of the efficient market hypothesis, I believe that only the weak form is valid. Specifically, by finding securities whose prices depart appreciably from underlying value, investors can frequently achieve above-average returns while taking below-average risks. The pricing of large capitalization stocks tends to be more efficient than that of small capitalization stocks, distressed bonds, and other less popular investment fare. Investors are more likely, therefore, to find inefficiently priced securities outside the Standard & Poor's 100 than within. Many buyers and sellers of securities are motivated by considerations other than underlying value and may be willing to buy or sell at very different prices than a value investor would. The behavior of institutional investors, dictated by constraints on their behavior, can sometimes cause stock prices to depart from underlying value. Value investing is one of the most overused and inconsistently applied terms in the investment business. Value investing is simple to understand but difficult to implement. The hard part is discipline, patience, and judgment. There are three central elements to a value investment philosophy. First, value investing is a bottom-up strategy entailing the identification of specific undervalued investment opportunities. Second, value investing is absolute performance not relative performance oriented. Finally, value investing is a risk-averse approach. Attention is paid as much to what can go wrong, risk, as to what can go right, return. The entire strategy can be concisely described as buy a bargain and wait. In investing, it is never wrong to change your mind. It is only wrong to change your mind and do nothing about it. Value investors, by contrast, are absolute performance oriented. They are interested in returns only insofar as they relate to the achievement of their own investment goals, not how they compare with the way the overall market or other investors are faring. For most investors, absolute returns are the only ones that really matter. You cannot, after all, spend relative performance. Absolute performance-oriented investors, by contrast, are willing to hold cash reserves when no bargains are available. Cash is liquid and provides a modest, sometimes attractive nominal return, usually above the rate of inflation. The liquidity of cash affords flexibility, for it can quickly be channeled into other investment outlets with minimal transaction costs. Finally, unlike any other holding, cash does not involve any risk of incurring opportunity cost, losses from the inability to take advantage of future bargains, since it does not drop in value during market declines. While most other investors are preoccupied with how much money they can make, and not at all with how much they may lose, value investors focus on risk as well as return. A positive correlation between risk and return would hold consistently only in an efficient market. Any disparities would be immediately corrected. This is what would make the market efficient. In inefficient markets, it is possible to find investments offering high returns with low risk. Risk and return must instead be assessed independently for every investment. It is only when investors shun high-risk investments, thereby depressing their prices, that an incremental return can be earned which more than fully compensates for the risk incurred. By itself, risk does not create incremental return. Only price can accomplish that. Unlike return, however, risk is no more quantifiable at the end of an investment than it was at its beginning. Risk simply cannot be described by a single number. There are only a few things investors can do to counteract risk: diversify adequately, hedge when appropriate, and invest with a margin of safety. The reality is that past security price volatility does not reliably predict future investment performance, or even future volatility, and therefore is a poor measure of risk. The trick of successful investors is to sell when they want to, not when they have to. Investors who may need to sell should not own marketable securities other than U.S. Treasury bills. If what you hold is illiquid or unmarketable, the opportunity cost increases further. The illiquidity precludes your switching to better bargains. The most important determinant of whether investors will incur opportunity cost is whether or not part of their portfolios is held in cash. Maintaining moderate cash balances or owning securities that periodically throw off appreciable cash is likely to reduce the number of foregone opportunities. An added attraction of investing in risk arbitrage situations, bankruptcies, and liquidations is that not only is one's initial investment returned to cash, one's profits are as well. Another way to limit opportunity cost is through hedging. A hedge is an investment that is expected to move in a direction opposite that of another holding so as to cushion any price decline. If the hedge becomes valuable, it can be sold, providing funds to take advantage of newly created opportunities. Hedging is discussed in greater depth in Chapter 13. Conclusion: the primary goal of value investors is to avoid losing money. 3 elements of a value investment strategy make achievement of that goal possible. A bottom-up approach, searching for low-risk bargains one at a time through fundamental analysis, is the surest way I know to avoid losing money. An absolute performance orientation.